Welcome to It's the Economy. US President has once again thrown a surprise at global markets by pausing the tariffs. Of course, globally, stocks have responded enthusiastically. But does that improve the prospects for global growth? Does it decrease the fears of recession? For some of these basic questions, I have with me the chief economist of Fitch Ratings, Brian Coulton. Brian, thank you very much indeed for joining us today. The world and investors all round are confused. What's your first impression with the tariffs being paused for a good 90 days? Does it improve the prospects or at least reduce recession fears?
It probably improves the prospects relative to the beginning of yesterday, but big picture, this has been complete chaos, and clearly the market adjustment has been too much for the White House team to bear, and particularly I think the volatility in the equity markets was something that they seem to be able to stomach, but the bond market sell off in the last 48 hours, I think, was something that was probably quite a concern. So, it's been a kind of dose of sobering reality, really. The rules of economics still apply, and you can't make these very, very aggressive policy changes without markets getting really concerned about it and without real material impacts on the outlook for the economy.
Okay. Well, since you touched on the bond markets, can you explain a bit? The chatter across all markets, all major markets, is that it was the spike in bond yields to 4.5% and the devolvement of the US Treasury auction on Tuesday that rang alarm bells. Can you just connect the dots for us?
Yeah, I think the context here is the US government is still running a very large fiscal deficit, despite the economy having been very strong the last two or three years. And so the backdrop is that the market concerned about the amount of supply that it's going to have to absorb. Remember, the Fed's no longer buying. They're not reducing their portfolio bonds quite so quickly. Maybe even pausing it for a little while. But that's the backdrop here. And when you see this sort of volatility, one other key development I think has been that if you look at the ownership structure of US Treasuries, we have an increasing share of what you would call like non-traditional holders there, in terms of sort of pension funds, insurance companies, more hedge funds, more money market mutual funds, more sort of slightly more flightier money, and I think that has been something that's created volatility. Normally when the market generally and the media generally is talking about a rising US recession risks and slower growth, what happens is that bond yields go down. So the fact that they started to go up pretty rapidly, I think, was a shot across the bows and was a signal that the market is concerned about supply. We had evidence of that in the last 12, 18 months. Other occasions when the Treasury has raised their borrowing requirement, we've had a rise in bond yields, got nothing to do with the outlook for the economy going in the opposite direction. So I think it was a bit of a shock. Okay,
but what do you think caused that buyer's strike on Tuesday and even Wednesday, for that matter? Yields, even after the president announced that he's pausing the tariffs, didn't quite fall below 4%. They are still high. So what is causing the buyer's strike? Is it these short-term hedge funds who are now scared that there may be immediate inflationary fears? Or is it, the big buyers? Japan holds over $1 trillion of US Treasuries. China owns $760 billion from the last data I picked up from the US Federal Reserve. Are these people striking?
I don't think it's possible to sort of to tell. I mean, I know that's been the narrative, and clearly, central banks in Asia are big holders of treasuries, and the trade war, naturally leads to this speculation that there might be some sort of buyer strike. But this is a big and very, very liquid market. We just don't have the information to know if that's what happens. I think maybe a more credible story is that these non-traditional investors, which include hedge funds, they're leveraged investors, and we know they've been taking positions on something that's called a basis trade, the difference between the synthetic bond yield from the swap market and the cash bond yield, and with the volatility in the market, those leverage positions have been exposed, and I think there's a lot of market commentators that are following the market in detail a lot more closely than I am, but there seems to be this story that there's been an unwinding there related to the leverage positions, and this has been something that we've seen before in the March 2020 sell-off in the bond market. We know with the outlook for the economy was collapsing under the pandemic shock, and we actually saw bond yields rising back then. The Fed had to step in, so we know this unwinding of leverage positions is an issue, has been an issue in the past, and there does seem to be some credibility to that story that this was part of what was going on in the last 48 hours. Yes,
we did hear the chatter about this basis trade and over-leveraged positions there. But to zoom out back into the global economy, what's your base case now? Will tariffs come back in some fashion? Will it remain this 10% which has been imposed on all countries? And what may be the consequences of that? Are we going to see, nevertheless, a recession in Europe or a slowdown in Asia? What is your base case?
I think the only thing you can say with complete certainty is that under this US administration, we're not going back to anything like the US trade tariffs that we saw before they came to office. So the US effective tariff rate was 2.3% at the end of 2024. Now, depending on what you assume, it looks like we're in the region of somewhere between 25 and 30% now. That's a massive change. Even with the 10%. The 10% rate rather than the additional reciprocal rate on all those countries that got hit with the additional rate on Liberation Day, even with that going back to 10%, because he's pushed the China rate so high, and China's a huge trading partner. We're still at 28-30% is the number. That's a massive change, and that is going to have definite negative impacts on US and global growth. Now, whether we get an outright recession in the US, 2 days ago that was looking pretty likely. I think the pause has probably reduced that likelihood a little bit. One thing you do need to remember is that the US government is going to get quite a lot of extra cash as a result of the tariffs. It's not going to be possible to shrink the volume of imports that quickly. So the higher tariff is going to lead to some additional coffers, maybe in the hundreds of billions of dollars. Now, is the US government going to save that money? So that's a direct drag on the economy, or are they going to recycle some of that money back into the US economy? And I think it's probably more likely to be the latter. So we'll see those extra tariff duties used to fund some tax cuts.
Well, before I run out of time, how would you look at it from an India point of view? Our own exposure to the US in terms of exports is only 2% of our GDP, and we are unlikely to lose all that in terms of markets. But will you have to mark down our growth because of an overall global slowdown?
Well, you're right in saying India's not such an open economy. I mean, the US is a pretty important market of the exports you do. I think it's a pretty big chunk of India's export base, but exports are not that large a share of the economy. So that's certainly true. Relative to some of the other countries that got hit with the other countries that got hit with the reciprocal tariffs, it's much less. It's a much bigger deal for a place like Vietnam, for instance. But we're talking about relative losses here. Even if it stays at this 10%, with the pause that we've got, even if it stays at 10%, 3 months ago, a 10% US tariff on China would have been seen as an absolute shocker, right? So you got to keep that perspective. I guess what's in India's favor is that they access to the Indian market is something that I think the US administration would see as a highly valuable prize. So there is definitely something for India to offer if they are prepared to bring down those tariff rates, which are obviously much lower than the numbers the US published. The 50% they published is kind of based on some kind of fantasy economics, but even so, it is quite high. The MFN rate is 12%. So if there is a bilateral trade deal which brings that down, I think you can see prospects for some sort of negotiation there. So India may be, I wouldn't say a relative winner, but maybe I don't think there's any winners from this trade war, but it may not lose out as much as some of the other Asian countries that got whacked with the reciprocal tariffs.
Okay. Well, the Reserve Bank of India announced its own forecast of GDP growth this year, and they have brought down the GDP growth forecast by only 20 basis points from 6.7% earlier to 6.5%. You think there's the downside risk?
We haven't reworked our numbers on this, but yeah, there are some countries where we'd be looking to bring down growth by quite a substantial amount. I think India is sort of at the lower end of the spectrum. So yeah, quarter point, that sort of range doesn't off the top of my head seem completely out of line.
Okay. Finally, would you expect a currency war? We did see China's the PBOC adjust the fixing lowest in a couple of years, we are told. So do you think that there can be competitive devaluation? Is that a danger?
It's certainly a danger. It's certainly not my base case, but if China's looking at ways to offset this really dramatic, super aggressive US trade policy approach, and they wanted to support, their export sector and enable them to gain market share in the rest of the world to offset that, the shock to that $500 billion of exports that go to the US. Slashing the RMB against the US dollar would make sense from an economic policy perspective. If they were to do that, that would unleash a huge amount of volatility in the emerging market currencies. I'd be surprised if they go for it, to be honest, because I think they would see that would raise the risk of creating sort of instability in the capital account, and a major risk of, would create instability.
Thank you very much, Brian Coulton, for joining us in this conversation. Well, that's it on this edition of It's the Economy. Time for a break. It'll be Chartbusters thereafter.